What will it take to see housing prices fall in the U.S. housing market? Well, let's take a look at where we are. Right now, we have rapidly increasing market times across the country. We have prices that are basically flat for most of the country since October 2023. So a lot of people are asking, haven't prices come down? You're seeing a lot more price reductions, but that doesn't mean that prices come down. Just because a seller overlists their property or an agent convinces a seller to overlist their property doesn't mean that prices are coming down. What you look at is you look at closed sales data. And as you look at it, we did have a peak in October 2023. Then it went down, it dipped, and then it went back up through the middle of the year, through summer, and then now we're back down. In the short term, what do we need to see for prices to fall? They're falling now, but that's not what you mean, and I know that. What's happening is they are trending upward overall. So in order to see prices trend downward over time, or as the Fed chair likes to say, for duration, right? For prices to fall for duration, I think there's a couple of things we need to see. I think we need to see some pain in the economy that will bring the Fed rate down. So something somewhere is going to have to break. We're going to have to see that happen, and that's going to have to happen. It's going to be, I think, very dramatic in order for housing and shelter costs to come down. Also, the way that the Fed looks at shelter and housing costs is kind of a goofy metric. Out on the street, on Main Street, we're seeing that there's a really stickiness factor to the prices despite raising interest rates, despite high costs, despite prices, like I said, going up. We're still seeing a lot of buyer demand, and that's mostly because of low inventory. So when you look at, like Redfin has a stat out, they said 2.5% of homes in the United States has changed hands in the last year. So out of every 1,000 homes, so think about your neighborhood, probably 300, 400 homes. Out of every 1,000 homes in the last year, 25 of them were on the market and changed hands. That is the lowest inventory number and lowest transaction count we've had in decades. You're hearing it from the realtors, and the realtors are struggling because there's not very many transactions happening. One of the things that does is it keeps prices elevated because there's still demand for every property, even if it happens slower, even if it is kind of like pulling teeth because things are expensive for the buyers and the buyers are very, very tight with affordability, very tight with negotiations. They're negotiating very hard, and there's not as many offers coming in for every listing. Prices are still steadily climbing. Nationally, generally, since the 70s, we see about a 4% raise in prices every year. Through COVID, we saw double-digit price increases, which is really, really painful, especially in high-cost areas. As things slow down, though, that 4% number is kind of a very typical, normal metric to pay attention to. The reason I bring that up is as inventory comes on the market, as more homes come on the market, I think we'll still see prices increasing because of this thing we call the magic interest rate. And this is kind of a newer term. You're probably hearing it a lot on social media right now. The magic interest rate that most of the economists, most of the people looking at this that are saying it needs to be between 5 and 5.5%. Now, I do not mean Fed funds rate. I mean the purchase interest rate for your mortgage needs to be between 5 and 5.5%. That's based largely on polling of homeowners and understanding what they would need to see in order to be willing to put their home on the market. So what's happening is everybody's got equity in their home. Let's say I'm in California. So let's say everybody's got $250,000, $300,000, $500,000 in equity in their homes, but they can't get to it without dramatically increasing their purchase price because interest rates are so painful. When they were polled, most homeowners, statistically the highest number of homeowners, said between 5 and 5.5% that when rates got to that point, they would sell their house, put it on the market, so it becomes a transaction that can happen. They would take their $200,000, $500,000 in equity, put that in a new house with a new payment at roughly an interest rate between 5 and 5.5%, and be comfortable with that new payment. We know that affordability impacts this, and everybody buys generally based on how much they pay per month. So it's a simple supply and demand. Sellers are stuck. They have plenty of equity, but they can't get to it. Buyers are feeling like they don't want to rent, so they jump in the market. As we see inventory that exceeds demand, then that's when we'll start to see prices fall. But right now, there are still 2 to 7 buyers for every house that's on the market. So as we see more and more homes come on the market, it's a balancing act because most people that are buying right now are going to be also selling. So it's one for one, right? One on the market, one off the market. And then you add in those other buyers that are coming on until we get to where there are more people selling and failing and not buying something else and going to renting or coming, coming on the market, sitting on the market, giving buyers options. That's when you'll start to see the prices fall. Now, that's unlikely to happen before the next boom. So you heard me right. I think that as interest rates come down, there will be a boom in prices. We're going to see another COVID crazy session where prices go up dramatically because homes are coming on the market. So as you're a buyer, you're watching this, and I just said that you're frustrated. I get it. And it sucks. And it's hard because things are getting more and more expensive. And you feel like maybe you missed it through COVID. And then here we are in 2024 and you feel like maybe you missed it again. But how in the world can people afford this? I hear you. I see you. And here's what I would do. There are a couple of things that you should do. So develop a plan, talk with a real estate agent, talk with me. And by the way, anywhere in the country you're buying, talk with me first. I can find you a great real estate agent in your area. I've got a network across the country. So talk with me first, develop a plan, figure out what that number is, not what a lender says you can afford, because it will be higher than what you want to pay. Find out that number that you want to pay. What's that comfortable number? Then what you do is you back into that with the interest rate, with your down payment, with availability of homes in that price range. And then you can also consider, and this is important, you want to do this before the market shifts. So right now things are slow. You can consider rate buy downs. As the market gets crazy and there's tons of buyers that can afford homes and all these sellers are coming on the market and all these things are happening, rate buy downs are going to become very, very rare like they historically have been. But right now we're seeing them and sellers are happy to do it. What a rate buy down does is you pay an upfront lump sum of money, you or the seller, you can negotiate this into your deal, pay an upfront lump sum of money to the lender to, instead of getting a 6 3/4 rate, and I'm not quoting rates, but just hypothetical, 6.5, 6 3/4, 5, whatever it is, then you can pay up front to reduce that rate. And that number that you have to pay and how much it reduces your rate changes from deal to deal. So we should talk to figure out what that is going to be for you. But once you do that, then you, the seller, gives it up in concession. So maybe you pay a slightly higher price and you finance that over the next 30 years, but you get a reduced payment for the life of your loan. Now, could that be 30 years? For some of you, maybe, but statistically speaking, 7 to 11 years is how long most homeowners are going to hold on to their homes. So for the next 7 years, are you going to hold on to this loan or are you going to refi out of it in 2 years because your rate's sky high? So these are all things that you want to consider as you're doing this. And I hope this is thought-provoking. My strongest suggestion to you, though, is I started this video by saying, what will it take for prices to come down? My strongest suggestion for you, don't wait for prices to come down because they will, but not before they go up again. So unless you're comfortable renting for the next 2 years plus, I might suggest that you jump in now, you bite the bullet, you tighten up, you do the best you can, and the benefit to you will be huge. Think about all these people that bought during COVID. They don't necessarily love their home. So those are going to be the people that jump on the market. But they were the people that heard this message the first time around, jumped on it, and now they're sitting on, here in California, $200,000 or $300,000 in equity. I mean, ask me, I'm one of them. So one of the things that happens is you get the opportunity to develop equity on leveraged funds. So you didn't put down $200,000. You didn't buy a house $200,000. So you get to leverage your equity. So you didn't put down the entire amount of that asset that you're gaining equity on. You bought with a loan. So you put down, say, $20,000 on a $200,000 loan, right? That's $10,000. That's 10%. And now you control the entire equity of that whole $200,000 loan. So you're developing equity at 4% a year. What's that? $8,000 a year. And you only invested $20,000. So in 3 years, you actually made your cash for cash money back. That's a good investment. I don't care who you are. You will never beat that in the stock market. But real estate, it happens all the time. So when you consider that, that's why these people are coming in. That's why they have such good assets. And they just made the decision to tighten up for a little bit of time. If you are insistent on waiting for prices to come down, expect prices to come down, and they will. but you're going to be higher than you are today because of inflation, because of leverage money, because of the 4% a year being on the whole amount, not just the down payment amounts. It's going to be higher than it is today. Now, you may have a lower payment because interest rates are likely to be lower. And maybe prices crater like they did in 2008. Nobody knows. I'm not saying they won't, but I'm not saying they will either. And it doesn't look like they will. There's no economic data to suggest currently that they will. So I wouldn't wait. I would jump in now. I would find the best house you can for the dollar amount you can afford, and everything else is noise. Thanks for tuning in. I'll catch you next time.